Hey guys, Clay Rockwood here. I wanted to go over quickly the different terms in the language associated with commercial real estate in general, but more specifically, multifamily. Right, so this is again, I think a common thing that stops people from getting into multifamily in general, or from going into, from smaller to larger deals, because there's certain terminology and language that you have to understand in order to have, relevant conversations and to understand what people are even talking about in this space, right? So I find it helpful to just kind of learn the basics. Right now, you don't have to know everything. You don't have to be an expert at all the different intricacies of underwriting a deal and knowing all the different metrics, right? But having a base knowledge of the terminology and the common terms that you're going to hear thrown out is going to help you at least be able to have intelligent, conversations with people and at least understand when you look at a deal what you're looking at. Today I'm just going to be talking about some of the terminology, but in another video I'm going to break down an example of actual numbers that you should expect or that are common in today's market for these types of properties. So first thing you're going to see a lot is the IRR and the equity multiple. Now these are two metrics that are used very commonly in commercial real estate to analyze and underwrite a deal, right? So it's a quick snapshot for investors and for us as the operators to see, is this property or is this project a good deal or not, and what kind of return am I going to get? So the IRR is short for the internal rate of return. Now this is a very complicated calculation, but basically what it is here, the definition is, it's an estimate of a future annual rate of return. Now that may sound confusing, which is fine, but don't get confused by this. It's basically a calculation that you use in an Excel model or an Excel spreadsheet that kind of calculates out for an investor or for the timeline of this property or how long you're going to hold it, what your estimated annualized return is going to be. And the beauty of the IRR function is that it takes into account the time value of money, how long you're going to hold the property, so it takes into account the length or the term of the hold, and the annualized return. So it's just a simple metric that's used commonly in the industry to tell you what is the averaged annualized return you're going to get on your money in this property. Okay, so again, don't get confused by it, but it's a great metric that's used. It has better functions than just like an annualized return or even just a cash on cash return. It kind of takes into account a lot of different variables and averages that out over the lifespan of the property or how long you're going to hold that property. Okay, so that's the first one you're gonna see a lot is the IRR. What is the IRR, the percentage IRR return you're going to see annualized on this project? Now the next is the equity multiple. Equity multiple is a metric that calculates the expected or achieved total return on an initial investment. Now again, that may sound confusing. Some of this, definitions are. But the equity multiple is a great metric that I like to use a lot because you pair it with the IRR and it really gives you a good understanding of, within a couple of minutes, how is this project going to work? What's the return going to look like? So equity multiple, for example, a lot of times you'll see it as a 1.7x or 2.0x, right? So what that basically means is saying, hey, if I invested $100,000 into this property, and let's say I hold the property for 5 years, and let's say I'm projecting a 2x multiple. That's saying, well, okay, for my $100,000 investment, I should be able to 2x that investment. So I should turn $100,000 into $200,000. So it's a simple, quick math equation, really. So whatever the equity multiple estimate is, or that you're seeing out there, or that some groups pitching you and they have an equity multiple of 1.5 or 2x, you just take that number times by whatever investment amount you're going to make. And that's about the return you're going to take over the lifespan of the property. Now that accounts for cash flow during the process and the big money you get at the end when the property sells. So again, when you pair that with the IRR gives you kind of an annualized return. Equity multiple will show you the overall return you're going to get on your money. So it's a great metric. When you pair these two together, it's a quick snapshot to show you how this project's going to perform, right? Then we talk about the preferred return. This is another common term you'll hear in the commercial space. The preferred return is the minimum return an investor must receive before an investment manager can earn a performance fee. So to break it down simply, because I'm all about simplicity, right? I'm not trying to confuse you. So how to explain this simply is a preferred return is typically a percentage that we pay, or any group will pay an investor on their money before we as the operators or the sponsors or the general partners get paid anything, right? So most deals you'll see out on the market, let's say it's an 8% preferred return. So we say, hey, Mr. Investor, you invest $100,000 with us. I'm gonna pay you 8% on that money every year. And typically that's paid out, could be monthly, sometimes it's quarterly. But let's say they have their money out for 5 years. They say, hey, every quarter I'm gonna pay you off from the cash flow that comes in from the property, 8% on that money. Now, once we've achieved that preferred return, the minimum return, then kicks in the equity split. And we'll talk about the equity split in a second, but that's just a way to ensure that the investors are getting paid first before we take any money. So it's almost like a guarantee. It can't be a guarantee, but it's a vote of confidence for the investor to say, hey, we're gonna take care of you, Mr. Investor, first, at least up to this amount, and then we're gonna have an equity split based on the cash flow. So that's what preferred return is, and most deals you'll see in the market will have some sort of preferred return baked into the deal, which again plays into the overall IRR and equity multiple. So all these numbers kind of play into each other. And again, in my next video, I'll break that down with actual real life numbers, and so you can kind of see how this works in the real life. The last thing that I think is important to understand is these terms, the LP or GP. These are short for limited partner and general partner. This is pretty simple. The limited partners, they are typically the passive investors. So the person putting up the money for the property, but they're not actively involved in running the property and managing it and implementing any of the business strategy or plan, right? They're just the passive investor that put the money, and they're banking on the operator or the general partner to do all the work. And that's what the general partner is. It's the active operator. So typically when we buy a multifamily property, we are acting as the general partners, right? We're sourcing the deal, we're negotiating with the sellers or the broker, we're getting the debt lined up, we're raising the money, we're doing the heavy lifting as the general partners, but we're relying on limited partners to fund those deals for us, right? To invest with us passively. So those are, again, you'll hear these phrases thrown out like LP, GP, and again, if you're not familiar with that, it could sound like Greek, right? So LP, GP, what are you talking about? Well, they're just talking about the limited partner or the general partner. Now again, this is where the equity split starts coming into play. So typically, limited partners will get a percentage of equity of the property, and the general partners will get a percentage of equity in the property, right? And this is how you kind of split the deal up. Typically, the limited partners will get a larger share of the equity in the property because they're the ones putting up all the capital. They're having the risk of having their money out on this project, where the general partners sometimes invest some of their money in the deal, but a lot of times the general partners aren't investing anything but their time and energy to do this. So they typically have a smaller portion or share of the overall ownership in the property. So hopefully that helps you guys understand just some common phrase, like if you can just learn these common phrases, common terms within the commercial multifamily space, you're gonna be able to understand a lot of what's talked about. When you see a pitch deck or an offering memorandum, like you'll be able to see what some of these terms are and what they mean. And again, in the next video, I'm gonna break down real life numbers of what returns you can expect and what numbers are realistic to see in today's market.
Thanks for watching. Hey, if you feel like you don't know where to start or how to find deals, I have created a multifamily marketing system to help you generate off-market seller leads. This also includes the scripts that I use, actual recorded calls with sellers, and case study archives. And as a bonus, I'll throw in a masterclass on how to find deals straight off the MLS. So click the link below in the description to go ahead and get started.